These are certainly bad times for Africa's biggest economy. The Naira has failed to halt its free fall against the US dollar, currently trading well above 200 Naira per dollar at the interbank market and the official target band of 160 to 176 Naira to the dollar. To check the seeming fall of the currency, the country's central bank is now planning to sell dollars at the interbank market at 198 Naira to the dollar, well beyond its target band. But financial analyst Johnson Chukwu says the Apex Bank must begin to consider devaluing the Naira further if it hopes to achieve stability in the forex market.
With low foreign exchange earnings, with heightened political tension which has constrained portfolio investors from coming to your market, and with our dependence on imported goods, it will be difficult for the central bank to sustain the defense of the Naira. So I think the appropriate thing is to depreciate or devalue the currency to the parallel market rate, which actually mirrors the equilibrium price of dollar.
Central bank has made it clear it does not plan another devaluation less than 5 months after it devalued the currency by 8%. It is now asking commercial lenders to submit their dollar demand levels and not to sell dollars purchased from the central bank among themselves on the interbank market in order to reduce speculation. But beyond the currency challenge, the economy also faces the risk of being downgraded. Global ratings agency S&P has already placed the country's credit ratings on watch for potential downgrade.
At the next review, if nothing significant happens, S&P is likely going to downgrade Nigeria's rating. What they're saying now is that, look, Nigeria still has the capacity to meet its obligation, but that has been weakened. And that it's very likely that if nothing changes, Nigeria's capacity to meet its foreign currency obligations may no longer be sustained.
The good news for the country, however, is that oil prices are beginning to pick up. Current prices of $61 per barrel may still be below its national budget oil benchmark of $65 per barrel. Authorities are hoping the current upward trend is sustained. But some analysts say despite oil prices gradually picking up, the government will resort to borrowing to finance its budget.
It is impossible for the federal government of Nigeria not to borrow to fund this budget. You just have to borrow. You must go out borrowing because you haven't got enough savings. That's the problem. And the production or manufacturing base of the economy is something very precarious, very low. In fact, it's not contributing much.
Yet another negative news for the economy is that inflation rate has now risen to 8.2% for the second consecutive month this year. The government has been forced to significantly slash its capital budget for 2015. Factors that whoever comes to power after the elections in March would face a huge struggle to get things moving again, especially in the face of shrinking revenue. Deji Badmus, CCTV, Lagos, Nigeria.